I want to thank Ackerman. They've allowed us to, put this event together inside of their office for the past 10 years. They've been an excellent partner. I want to thank all of our members of FLYA. We have, a number of them in attendance today. Forvis is our most recent addition to our family here in Miami, and want to thank you for coming. And want to get into the presentation today. So today I have with me an expert in portfolio management, macroeconomic research. He has an excellent pedigree. He's worked for some very, very, notable figures in the alternative investment world. So it's been great to have Bob Elliott, the founder of Unlimited Funds, as a friend and somebody that I can bounce ideas off of that's extremely bright. So I'm not going to steal his thunder from him on his background and his pedigree. I'm going to let him tell it and get into, the case on inflation that he's going to discuss today. So with that said, Bob, thank you very much for coming today. If you can just give a brief overview of your strategy for unlimited funds and how people can access it.
Great. Yeah. Hey, everyone. Bob Elliott, one of the co-founders and chief investment officer at Unlimited. My career has been 20 years in the 2 and 20 space as a systematic investor. I was a deputy chief investment officer at Bridgewater Associates, where I was part of the sort of small group of investors that helped bring Bridgewater from being a niche player to being the institutional incumbent in the hedge fund space. And through that time, built investment strategies, systematic investment strategies across all the major asset classes. And so really my core set of thinking and skills and focus is around macroeconomic concepts and thinking, which I'll talk a little bit more about today. I also spent some time on the private side of the 2 and 20 space, running a $125 million venture capital fund, which systematically invested in early stage consumer opportunities, sort of big data and systemization in the venture side. And I, after 20 years of doing this, it sort of increasingly became obvious to me that for 2 and 20 investing, it's really good for the manager and not great for the investor. And that reason why that is 2 and 20 managers are really good at producing alpha, really good at producing high quality return streams. And they're also really good at taking those away in fees, leaving investors not much better off than they would be on their own. And so I set out starting a little while ago to think about whether there was a way to bring the sort of low cost, diversified indexing concepts that have revolutionized stock and bond investing in the public markets, whether those could be brought to the world of 2 and 20. And now we'd have to do that in a way that's quite different. There's a lot of work being done democratizing alternatives, but a lot of that work, what it is putting a layer of fees and platforms on top of what are already relatively expensive products themselves. And what we wanted to do was do something very different. And so what we have built over the course of the last year is a technology that allows us to look over the shoulder of 2 and 20 managers, infer what they're doing in close to real time, and then be able to translate that understanding into positions in liquid securities that we can package in an ETF structure, which is the ideal structure from a tax efficiency, liquidity, and transparency for the everyday investor. And so our first product, as Mike has mentioned to many of you, is the HFND ETF. It is HFND like hedge fund. It is a product that seeks to replicate the gross of fees returns of the hedge fund industry, which, when you think about that return stream, it's actually quite a good return stream. If you can buy into hedge funds at low fees, it's a very good return in terms of, better than stocks, half the volatility, a third of the drawdowns is what that return structure looks like. Packaged in a form that is at a 95 basis point management fee instead of 2 and 20, and in the tax efficient structure of an ETF for taxable investors. That launched 6 weeks ago. We have $50 billion or $50 million. I wish $50 billion. 50 million. You can see where we're going. $50 million in that product. In 6 weeks, it's the fastest growing independent, actively managed ETF in the last many years, the last 5 years or something like that. We're getting incredible receptivity from the allocator community, who sees how the hedge fund style strategy in an ETF wrapper really helps address a lot of the pain points that many RIAs and family offices and taxable investors face, which is there's no paperwork, it's liquid, it's tax efficient, and you could put it on in size for everything from the small scale investor in your book, to large scale investors as well. So I'm really happy to come talk here. Part of our goal with Unlimited is not just to provide access to the return streams of 2 and 20 products through the structure of our ETF, because that's just really one part. I think if you look at the most sophisticated asset managers in the world, what they do is they not only provide their clients return streams, albeit at too high a cost, but they also provide them unique, differentiated insight into what's going on with the macroeconomy or whatever their specialty area is. And so part of our strategy at Unlimited is also bringing a fair amount of that insight as well. And so while you can check out HFND, on the ETF on any of the major platforms or investment brokerage houses, you should also check out some of the work that we're doing through Twitter and my handle at Bobby Unlimited, which is a very active perspective into the day-to-day workings of the macroeconomy and perspective there, or at our blog at unlimitedfunds.com. And so today, rather than talk too specifically about the product and its nuances, I thought this would be a great opportunity, given, it's December, we're all sort of thinking about what does 2023 look like, to take a minute to talk a little bit about what 2023 could look like. Like, let's be honest, 2022 was an extraordinarily painful year for most investors, right? It was the worst 60-40 returns in decades. It was the worst bond market since the American Revolution. This is not the crypto market totally collapsed. This has not been a great time. And a big reason for why that is that we've gone from this era of 15 years of the easiest monetary policy that had existed in the modern world, in hundreds of years, the easiest monetary policy in hundreds of years, which existed for 15 years, try and get us out of the financial crisis. And we're transitioning quite quickly to a world where the era of easy money is over. We're entering an era of tight money. And there's a lot of second and third order consequences that exist there for many investors. And so it's a lot of investors, particularly this year, were unprepared to see a 2022 that experienced higher than expected inflation, stronger than expected tightening of financial conditions. And I think one of the things I really want to help people see is that 2023 is not a return to normalcy. It's not, okay, that was painful, we took a slap, let's get back to the 60-40 basics, let's get back to just investing in beta and everything will be fine. I think in a lot of ways, people are underappreciating how much 2023 is going to look like 2022 when you look at the dynamics that are going on. And so that's what I'm going to talk a little bit about. I describe this, maybe it's bad branding, but I often describe this as the inflationary slog, right? Because that's going to be kind of the feeling here. Most of us in our professional investing careers, we remember 2020, and that was probably the sharpest V-shaped dynamic that you could possibly have experienced. Many of us went through 2008. Most of us in this room went through 2008. And that too was a relatively V-shaped recovery. And most of us here, either a a normal macroeconomic cycle is a distant memory or we've never lived through it, right? And so I think it's important to come back to the basics when you're thinking about how things are likely to play out. Normal macroeconomic cycles are slow, they are boring, and they feel like a slog. As an example, if you go back to the 2000 cycle, just to keep this in your mind before we turn to the facts and figures and particulars of what's happening today. In 2000, stocks peaked in March of 2000. Employment started to deteriorate meaningfully 12 to 18 months later. And the stock market technically bottomed in 2002, but really bottomed in the spring of 2003. Essentially, that was the longest low point that existed. That was 3 years of terrible economic conditions, right? From the spring of 2000 to the spring of 2003. How many people here are prepared for 3 years of miserable economic experiences? Tight money, high inflation, deteriorating labor market. How many people here are prepared for that? Nobody is prepared for that. And so that's what I want to emphasize is now is the time. We have a unique opportunity today to start to prepare. Yep, we might have been a bit behind the curve here for the first couple, for the first few innings of this macroeconomic cycle, but now is the time to prepare yourself to think about how are you going to get ready for 2023 and beyond to get your portfolios, your investing, your risk controls, all of that. How do you get ready for years of an inflationary slog, not just months of an inflationary slog? So let's get into it. When we look across major developed world economies, I'll go through the main points and I got some visuals behind this. When we look at the major developed economies, it's easy to sort of rush to be like, oh, we're in a recession, or oh, everything's okay. And I think part of being a longtime macroeconomic investor is recognizing that typically things are not either in total crisis or totally rosy. They're somewhere in between. And so when we look at what's going on with the major developed world economies, the US, Europe, UK, et cetera, Japan, what we see is basically a moderate growth situation, low unemployment, so tight labor markets, and frankly, continued broad-based inflationary pressures. And so what we're seeing in many ways is a very typical inflationary business cycle, an almost boring inflationary business cycle, right? And those business cycles, this is where we've gotten to relatively high levels of employment. We've gotten inflation as a function of that high level of employment and nominal demand. And as a function of that, we've gotten the central bank tightening in response to that, more so in the US than in Europe and the UK, and certainly in Japan. But that's kind of early. Think about it. It's like sort of third inning of what that typical cycle looks like. But when we look at what markets are pricing, they're pricing an end to the 2022 dynamics starting in a few months, right? I look at the macroeconomic cycle, it looks like we're in early innings. You look at the bond market and it says everything's fine. This is over. Why are we're in recession, inflation's coming down, it's all over. We're going to get cuts, interest rate cuts starting in a course of a couple of months. And that is very different that is a very different pricing environment from what you see in the actual macroeconomy. I think one of the things that's very interesting in this cycle is that most of us have never seen an inflationary cycle. Basically, any person who's seen a traditional inflationary business cycle is retired at this point, right? Right? And so part of that challenge we're seeing today is that most people don't know how to navigate through these cycles. And so when you don't know how to navigate through a cycle, when you haven't had that experience, and particularly when it's so uncertain exactly how this is going to play out, looking to active management is really critical to help navigate through that dynamic. And so when we look around, hedge funds, part of creating HFND was giving access to the everyday investor, giving them access to the most sophisticated asset managers in the world and how they're positioning and how they're navigating through these crises, through these difficult macroeconomic environments. And when you see what they're doing, what you see is they are uncertain. They don't really exactly know what to do They're running low risk. They're running conservatively. They're running in a position where they're trying to protect capital rather than lever up and take a bet on either recession or on soft landing, right? And I think that's a really interesting perspective because they've been able to navigate through this cycle much better than basically any other group of investors through the cycle. And then finally, I think it's really important for many of the folks who are involved here. We've got a unique time. It's December. People are looking at tax loss harvesting, and it's a great opportunity today to use that tax loss harvesting to go find some other assets that will be complementary to your portfolio. So let's get into it. The U.S. economy is doing pretty well. That's all there is to it. It's doing pretty well. Tales of the death of the U.S. economy certainly have not come true. When you look at the most recent GDP readings, we're looking at real GDP growth in the range of say 3 or 4%. You see that with the GDP now. You see initial claims, which are some of the timeliest reads on employment. You see that basically at secular lows, right? So people filing for unemployment is basically at secular lows. You look at the jobs report this morning. I don't know how many of you, woke up and went through all the jobs figures and things like that. What do you see today? You see basically job growth continues about as strong as it has for the year. You see wage growth basically at highs of this cycle. You see unemployment basically at lows. This is a pretty good economy, all things considered. Everything is kind of okay, which is interesting in the context of the amount of tightening that we've had, and also important to think about in the context of the fact that we have inflation that is still well above what the Fed's target is. And so let's talk about that. So we have a pretty good economy, and then we have an inflation problem, which is very normal in a business cycle where you have tight labor markets, high nominal spending. Very normal to get an inflation problem. What you see over here on the left is a decomposition of the CPI report into the various categories and what share of categories are experiencing inflation at what rate. And so you can see that 40% of the categories that in the CPI report are experiencing inflation that is on a year over year or on a 3-month moving average basis growing at least 8% annualized rate. So just take that for a minute. 40% of the things that you are buying on a day-to-day basis are inflating at a greater than 88% annualized rate. For people who walk into the grocery store, get a bite to eat at a restaurant, buy an airplane ticket, you sort of say, yeah, of course, right? Yeah, that's exactly what's going on. And it's very important to recognize that that is what the Fed is focused on. Here you can see Jerome Powell in the meeting at Jackson Hole was very focused. High inflation spreading through the economy. That's what he's focused on. So he's focused on the red. And when you go read the financial literature of why we should be pivoting, why the disinflation is here, everyone is focused on that little blue thing. Jerome Powell doesn't care about that little blue thing. He cares about the red thing, right? And what we're seeing is what's driving that is income growth. And that's what you see here on the right-hand side, which is we have wage growth because we have tight labor markets. We have wage growth that's running at 7 or 8% a year nominal. Well, if it's running at 7 or 8% nominal, you'd expect goods prices to go up at 7 or 8% nominal, right? Because people's wages translate into their spending, and that spending translates into buying goods, and that buying goods at those wages and that nominal spending translates into inflation. That's how it works. It's that simple. No reason to make it more complicated than that. And so what we're seeing is that the tight labor markets, which haven't changed, which we saw today, and the high wages are flowing through to high nominal spending, which is flowing through to inflation. And that's the problem. And even with all the tightening that we've seen so far, we haven't gotten that to break. Now, I think a lot of folks are US focused. I think it's important to recognize and sort of scan across the world. It's not this dynamic that we're seeing is not just in the US. There's differences in terms of what sort of created the initial inflationary impulse in places like the UK and Europe. There was more around, electricity and related to the Ukraine war, and the US was more around the fiscal impulse. But there too, they're seeing basically the same dynamics, which is fine growth, Europe, UK, Germany. Like here you go on the left-hand side, you just see the real GDP growth. It's moderated a bit, but it's fine, right? No one in Spain or Germany is really complaining about a couple percent of GDP year over year growth. Europe, you talk to people in the U.S., they think Europe is a disaster. Europe's not a disaster. Europe's fine. It's putzing along at a moderate pace at a relatively high level. You see that with the employment figures, that unemployment is at secular lows. And what you're seeing there is exactly the same dynamic, which is you have a tight labor market, reasonable growth, translating into inflation, which is spreading through the rest of the economy. And so you're getting the same exact dynamic, which is over here on the left, a whole bunch of measures about inflation in Europe, including various core measures. And then this chart here with the green and the blue, the same basic picture as in the US, which is you're starting to see higher inflation permeate. It's not just an energy story. It's not just a natural gas story. It's permeating through the economy, right? And that's what you're seeing in all of these in the US and in Europe and in the UK, this dynamic of a fine economy, not a great, but a fine economy in tight labor markets, rising wages, and high inflation relative to what's acceptable. And then let's talk about what trading markets, you have to look at what's going on with the macro economy versus what's priced in. So what are we pricing in? What are the markets pricing in right now? Well, what you see the markets pricing in over here on the right-hand side is the single greatest disinflationary experience of any high inflation economy over the last 50 years. Right, that's what they're pricing in. So that's what you see here. That blue line gives you a sense of all the times in which inflation has risen over 8% in economies since 1970. Right, there's something like 70 or 80 cases of this. And then what you can see is what's happening in the US and Europe, which is basically following the same path. If anything, the rise has been more rapid than many of those other economies. Right, this is only developed economies as well. I should mention this isn't like a emerging market crisis dynamic. And then what you're seeing penciled out into the future in terms of what's priced into economists' estimates, or if you start to look at what's priced into the interest rate markets, you're seeing a situation where everyone is expecting everything to go back to normal. Inflationary cycles don't go back to normal fast. That's just all there is to it. And if they start to go back to normal fast, the only way that happens is with a crashed economy. And so we have an okay economy, and everyone thinks that inflationary pressures are going to go back to normal. Those two things don't add up. It's not how it works. And in fact, when you get down to the nuts and bolts of looking at what's priced into the asset markets, into the rates markets, what you see in the US case, this has actually gotten more extreme since I put these charts together 7 days ago, right? This gives you a sense as to how fast this market's moving. But the expectation is for short rates to rise to 5% over the course of the next couple of months, and then start to get about 100 basis points or more cutting in the second half of 2023. There's no way that's going to happen. You can't have an economy that's running as hot as the US economy is right now, with real GDP growth running at 4%, and get the type of recession and have inflation running the way that it is, with almost 50% of categories over 8%, and have interest rate cuts happen within 3 to 6 months. It's not how it works. The same thing is true in Europe, except it's more extreme. Inflation is higher, and the expected interest rate tightening is much lower. And so what are we looking at here? Right? We're looking at a world where we thought 2022 was a surprise. High inflation, tighter than expected monetary policy, assets go down. We thought that was a surprise. Well, just wait for 2023, because we're going to get more of the same, right? That's exactly what's happening. And so the main question as an investor is, are you prepared for another year like 2022? And my guess is the vast majority of investors are totally unprepared for another 2022, let alone a few years of what we saw in 2022. When we look at who's been able to navigate this really well, part of what I think is really exciting about HFND is bringing institutional quality asset management to the everyday investor. And the way in which hedge funds have been able to navigate this cycle has been really compelling. Part of what hedge funds are great at doing in general is they're good at delivering pretty good returns when times are good, and they're very good at navigating challenging market environments to protect capital. You put that together and you get a better return with lower volatility than traditional index investing. And the great thing is 2022, what a great stress test of whether the hedge fund industry could deliver, and they did exactly that. So hedge fund returns in aggregate, if you put all the different strategies together, through this is through October, down a tad. How many investors would be happy to have that gold line right there, that gold bar right there, to have lived through this experience and kind of been okay, not too bad, right? Preserved your capital. How many investors experienced that return, right? I recently saw a poll on Twitter asked how many strategies were down, how many investors were down more than 10% this year. 80% of investors who answered that question were down more than 10%, right? And so that is the advantage of essentially hiring the hedge fund community to help navigate through these challenging environments. And how do they do that? Prudence, low risk, finding opportunities, incremental opportunities relative to what was priced in, being very careful to take on risk during a period of uncertainty. So, for instance, when we look at where hedge funds are positioned today, entering 2023, I think they're very well positioned for the type of inflationary slog that we just talked about. They've cut their stock risk. What you see here on the left-hand side is a chart of the gold diamonds are the typical positions of hedge funds through time over the last 25 years. The blue bars are where they're positioned today. And so what you see is a set of positioning where they're holding less equity risk than they typically would, much less bond risk than they typically would, which makes a lot of sense in the context of that bond market pricing relative to economic conditions that we're seeing. And they're holding a little bit of commodity risk as well. And even in the equity risk, even though the positions are a little bit elevated, what you see is they've totally shifted their equity portfolios to value-oriented sectors and away from all of the high beta stuff that's out there, right? Hedge fund investors right now are the opposite of buy the dip. They're the opposite of YOLO, right? They are boring investors investing in value opportunities, right, to conserve capital during a challenging market, right? And that, I think, it's really interesting because investors today, you go look at your portfolio today. How are you positioned? How are you positioning your clients relative to how the most sophisticated asset managers in the world are positioned? Right? Are you holding a big bond portfolio? Hedge funds are holding no duration. Are you getting back into growth stuff, thinking that that's going to make up for a tough 2022? Hedge funds are holding secularly low positions. In fact, what we see today is the largest divergence between the typical 60-40 investor and hedge fund positioning that we've seen basically in 25 years. We saw it over the last 6 months. You can see the differences in the performance between hedge funds and 60-40 and typical investors. And that divergence continues today. And so that's one of the great things. You can hire HFND essentially in order to help get exposure to these types of positions and how they evolve through time. Or honestly, take this information, go look at your book, and think carefully about whether you're taking too much risk in this difficult market environment and whether you can add diversification. And I think that's one of the things that's super interesting about this moment. Like, there aren't many silver linings in 2022. There really aren't. One is that we all get to join together here in person for the first time, right? That's a silver lining, a lot better than it was. I appreciate all the people on the phone as well, but that's a silver lining. One other silver lining is, for the first time in a long time, you can use you can go ahead and start to book some tax losses. It's not what you want to do, but you can start to book those tax losses, particularly in bond and recent stock market investments. And I think that's really a great opportunity because you take that tax loss opportunity, you take that freed up capital, and there's a lot you can do, a lot of progress you can make in getting prepared for an inflationary slog in 2023 with capital that you raise from tax loss harvesting. The chart here on the left-hand side is what you'd see you just took 10% of a 60-40 portfolio and you allocated it to one of these assets, right? So take 10% out of 60-40, allocate it to the different assets. And how much would that improve the efficiency, the risk return of your portfolio? And what you see here is there are a lot of great options. I could sit here and pitch you on one, this one or that one or the other one, but the short answer is take your money out of 60-40, take your money out of stocks and bonds, and find darn near anything that isn't equity and bonds, and it'll help prepare you for this environment, right? And so you look at the beta side of the portfolio, you see things like gold and commodities, which will create a much more balanced portfolio right away. Very easy. Even incremental allocations to gold and commodities can help prepare you for a more inflationary dynamic that might occur in 2023. It's also, as I said, a good time to look for alpha, right? To hire those sophisticated asset managers that can navigate through these environments very well. There's a lot of different strategies that are out there. That's what we show here on the right-hand side. All the different types of hedge fund strategies, whether it's global macro or managed futures or equity long short or fixed income arb. There's all these different strategies. And what you see in this chart here on the right-hand side is all of them are good. All of them are beneficial. All of them can really help an investor navigate through these market cycles, assuming you can find good ones and assuming you can find them at a reasonable price. And so, I show you here, if you just took your 60-40, you put 10% in commodities, you put 10% in gold, and you put 10% in diversified alpha, just like that. What it would have gotten you over the last 20 plus years, you would have had a nice benefit, a 15 to 20% improvement in your portfolio efficiency just from doing that, right? Reduced drawdowns, less month-to-month volatility, a much more pleasant 2022, just from doing that, incremental allocations, and you would have kept pretty low pure risk in doing it and improve your portfolio allocations. And that's what I'd emphasize here. If we take a step back and really think about what is going on here, these are times that we have never seen before in our professional careers. We need to recognize with humility the fact that we don't know how these dynamics are necessarily going to play out. And that given that, we need to prepare and diversify our portfolios away from what we've always done, the lessons we've learned over the last 20 or 30 years, because this isn't like the last 20 or 30 years, and find assets, find investment opportunities that are really going to help provide high quality, diversified returns in this difficult inflationary slog environment. And I think it's kind of exciting to start the day here, because of course I think you guys are going to see a series of very interesting, exciting opportunities that can do a lot of that, provide a lot of that diversification to the typical asset management portfolio. And so I'm really excited to see the series of different opportunities that are out there. HFN and HFND and the HFND ETF is just one of those, I think, exciting opportunities that are out there. If you're interested in learning more about the HFND ETF, check out unlimitedfunds.com. You can see exactly, you can learn more about what we're doing in terms of the fund itself, the product itself. You can also learn more about some of our thoughts on portfolio construction. A lot of what we talked about here today is in a variety of different blog pieces on unlimitedfunds.com. And also, if you want sort of more real-time sense of what's going on in terms of the macro economy and sort of real-time sense of thoughts, check me out on Twitter at Bob E Unlimited. We're very, very active. Love to see folks out on Twitter, very active in talking to folks and responding to folks and writing about what's going on in the global macro economy. A lot of what you see here was just clipped from my Twitter feed. So if you want to get a real-time sense of the outlook, go check it out. So thank you so much, everyone, for joining us, and Mike, thank you so much for having me and the team here. Look forward to keeping in touch.